Welcome to the Hedgeneer Podcast with your hosts, Michael Watson and John Viverani.
Hey everyone, and welcome back to the Hedgeneer Podcast. I'm your co-host, Michael Watson.
And I'm your other co-host, John Viverani. And today we've got Kelly Littlepage joining us on the podcast. Thank you so much for joining us, Kelly.
Thanks for having me.
Do you want to start by just giving the audience a little bit of a background on yourself, as well as what you're working on right now?
Yeah, totally. So my background is I studied a mix of computer science and math and control systems and economics, which sounds like a really weird combination. But the thing that I got really interested in when doing this was auctions, and specifically like how you allocate goods in a really efficient way for kind of complicated markets. And the example of this that was really topical when I was a student was this thing called FCC wireless spectrum licensing auctions. So we kind of take it for granted now that we have awesome cell service basically everywhere, but that had to get pieced together once upon a time back in the 90s. And economists were trying to figure out, how do you hold an auction for spectrum? Because, you know, we think of the 5G band as just like one thing, and it's actually hundreds of different frequencies. And if you're trying to buy it, you need to package it together across all these different geographies. And like some people want a bigger swath, other people want a smaller swath. Being a really interesting and hard markets question. So I got like sucked down this rabbit hole of thinking about these types of problems, and then started out my career in capital markets. And there was a hedge fund, and I was working on kind of what we would now call early high frequency trading or electronic market making. And I realized that like so much of what I was doing was really like a correction for the fact that these markets didn't exist and weren't used in capital markets. And that's really something that stuck with me. So when I got the opportunity I started a company called OneChronos in 2016 with the goal of commercializing these types of auctions in capital markets. So 10 years later, that's what we do. We're a US equities ATS that's moving into other asset classes and geographies. And the big thing that makes us different is our use of combinatorial auctions.
Awesome. Which for some of our audience that's not as familiar, the alternative is a CLOB, a central limit order book, where you put in an order, you say how many shares you want to buy of something or the quantity, you put a price, and you let that order sit on the book until you cancel it. And eventually the market's going to clear when somebody's willing to sell at the same price at the same time for a quantity that you're looking to buy it for. And that's generally what people think when they think about an exchange. But you approach it in a different way, where there's actually different intents that a user might have with multiple trades at the same time. And there's multiple counterparties involved. It's not just two people on each transaction in order to get an optimal outcome. Hard problem to solve. Do you want to kind of like explain it in probably more detail than I did around the difference between how you think about a central limit order book versus what you've built at OneChronos?
Totally. Yeah. And you teed it up nice because you captured the real essence of the problem, which is like in a limit order book, the things that matter are price and for most capital markets, time. It's like who gets there with the highest bid or the lowest offer, and who gets there first is who wins that trade. But the problem is if you're an institutional investor in particular, like it's pretty rare that you're thinking about anything in isolation. Like you don't care about the price of just stock A, you care about it relative to some index or some other stock. So most of the time you're like trying to trade a portfolio or you're trying to trade a pair. The challenge then becomes if you can only trade one thing at a time, you have what auction theorists call the exposure problem, which is you're going to bid or offer less aggressively because you're thinking like, oh, what happens if I win A and I don't win B? And that was exactly the problem that had to get solved for with Spectrum. So we just solved that directly by running this type of auction that allows people to put in like much richer intent than you would normally have for a limit order book. And they can totally use vanilla limits. Like a lot of our market is still people treating it like a CLOB, and that's fine. They get great execution quality from doing so. But there's that X factor if you can put in higher level intent than you could in a traditional market.
What's an example of a higher level intent?
The Paris trade, like I want to buy Google and I want to sell the market to like SPY as a hedge against that.
Yeah. In previous places that I've worked, we had to solve for that ourselves, right? And so you would make sure that one leg doesn't go too far of the other, and you're constantly tracking them at the same time.
Yep.
I think another area where it's pretty interesting is when you build your own custom basket.
Yep.
And so, like, let's say you don't want to rely on your prime for creating a basket for you, and you want to create your own kind of special iteration of that. Being able to leg into all of the constituents within a basket at the same time, so like 3 of those legs don't get filled, and then you're completely exposed to one component of the basket, which was not the intent of the basket in the first place.
Yep.
Is a hard execution problem. And so just being able to say, like, oh, can OneChronos help me fill my entire basket so I never go beyond certain exposures of any individual constituent? Like, I'm assuming that you see a decent amount of that.
Yeah. So that is the way that the system is built. Right now, the world is still built around pairs trades as far as like how our customers' systems actually interact with us. We're taking the next concentric circle out, though, which is exactly what you're describing. If you can do a basket. And good trading example of this is it's really common that if you have some names that are harder to trade than others, and then you have easier to trade names, a lot of times those easier to trade names are actually your hedges. So in a traditional auction, you go in and you say, hey, I want to try to get everything done in this basket in one shot. There's a pretty good chance that you get handed back your hedges filled and you don't get done in what you actually wanted at all. So like this is a direct solve for that problem.
Awesome. And is there like a discrete time stamp when you like kind of clear all the trades that have been submitted to you? Or is it something that's like, it's truly continuous? How do you think about like the element of time when you're building a custom matching engine?
Yeah. So it's pretty tied to the way the optimization actually works. And from the name OneChronos, one point in time, we run periodic call auctions that do this optimization. And part of this is just the practical reason that the optimization we have to do is really, really computationally intensive. And the reason combinatorial auctions weren't used in capital markets until we did was because they are such an expensive optimization problem. So we need some time to actually be able to clear that market. But separately, our view is that batch auctions perform well in general. So there's value in having discrete intervals of time. So you're not talking down to nanoseconds. You're actually letting the market accumulate liquidity, match in an orderly way, move on to the next one. It's kind of a two-parter where practically speaking, we have to because of the optimization, but even if we didn't, we would want to.
Awesome. How do you how do you manage that optimization? Do you guys write your own algorithms for that? Do you work with third parties? Do you rely a lot on academic papers and academic research in order to figure out what's the optimal implementation of the matching engine? Like, how do you even like, is it something that you spent like all this time in a dorm room trying to figure out? Like, how do you come up with what the right matching engine is?
Yeah, that's a great and very deep question. It's like, it's very tied to the timing history of when we started this company. So we got excited that what we're doing would actually be possible sometime around like 2015, 2016. And that is exactly the time when there was a lot of enthusiasm around the AlphaGo and AlphaZero papers initially. And that's no coincidence, since basically people discovered that you can use machine learning to accelerate classical tree search problems. Combinatorial auctions are one example of that. And then I believe it was the 2016 wireless spectrum reverse incentive auction, which was at that point the largest auction in history. It could only clear because of the use of machine learning to solve for this really gnarly constraint set. But it's not that the machine learning algorithm is itself running the optimization. It's picking the hyperparameters and start points and working with like a classical optimizer, like an integer programming solver to do so. So it's really the fusion of these technologies that makes it possible. And we write algorithms at every point in the stack. To your point, like we keep up on the academic literature. We also use off-the-shelf commercial optimizers for this. It's, the approach is literally called a portfolio of algorithms. The idea being that you get the best performance by stitching together a little bit of everything.
And how do you sell that to regulators?
So we were
The reason why I
Sorry,
asked
but-
that, right? Like there's best execution that regulators always want to make sure that you're providing your customers, and there's
Yep.
no like front running, or there's no like there's nobody on the exchange that's in a worse position than somebody else, and you're not getting paid under the table, which you're obviously not, right?
Yep.
But regulators need some way of verification of that, and when it's overly complex and turns into a black box, do they ever say like, hey, we just can't figure this out, it's too complex, I can't approve it? Like how do you think about getting semi-technical or not as technical audiences okay with giving you the rubber stamp?
So it's a really interesting point, because our view on it and the way that we've presented it is there's deliberate complexity, or I should actually say there's deliberate sophistication, and then there's accidental complexity. So like you can say the limit order book and the way that markets work right now is really simple. Like what's simpler than matching the highest buyer against the lowest seller? That sounds simple, right? But then when you go one level deeper than that, you realize that exchanges have literally thousands of order types at this point, all with very specific interactions that have to do with price points and what counterparties and rules for if something's going to rest or become passive or aggressive in different situations. That's all really complex. And what we do is we say, hey, there's this very simple mathematical objective that we're optimizing for here, which is we're trying to maximize price improvement dollars for each auction, saying the difference between what you were willing to pay and what you ended up paying for it, that's one price improvement dollar. So the optimization in the back end, that's just how the sausage is made. The part that matters is the fairness of the objective function and what it's trying to do. And that's very aligned with every definition of best X. Like in a way, we're literally mathematically optimizing for what most people would consider best execution.
Awesome. Is there like an Excel spreadsheet that you just dump out and send it over to the SEC and like, yes, intent, like the optimization is far better than what they were actually looking for. Good execution.
That kind of exists in the sense that price improvement is a factor that people look at both for their own definition of best X and for 605 reporting, for example. So tongue in cheek, but it does kind of exist. The really complicated question for best X in general is we're still talking point in time, like an algorithm buys 100 shares, but it's really the parent level order, or even the grandparents, they would say, that you care about and want to be measuring best execution for. That's very hard to thread through in a framework, because what the venue sees at the end of the day is in 2026 an order for less than 100 shares on average.
Now, I'd love to get into something else that you guys are kind of at the forefront right now, super topical to the industry, and that is compute futures.
Yep.
GPU futures in particular, but I guess it doesn't have to stop at that. I know you're deep in the weeds in it. Like, can you kind of walk us through what's the state of compute futures? I know you guys are going through applications that allow you to trade compute futures at OneChronos.
Yep.
Give us the lowdown. Like, what's the latest and the greatest?
So as far as what's live and what's been discussed as being live, both NYSE, or ICE, I should say, and the CME have proposals out right now for contracts that they'll list with different price-based benchmarks on it. In one case, a transaction price-based benchmark. In one case, reference prices from basically, you can Google and find the price of compute on some neo cloud.
Mm-hmm.
So that's the state of compute futures. And then there's prediction markets, which very early innings there for compute, but you're seeing people starting to either list or talk about compute contracts on that. But it's kind of like, it's kind of this interesting problem, because these things aren't usable by anyone that wants to like hedge compute in a meaningful way. And they're definitely presented as like, oh, this is a hedge for compute. But when you think about what does this future tie back to? What does it actually get me? The answer is it's the fairly opaque benchmark that's not tied to anything. And like you can say it's tied to transaction data, but it's not meaningfully tied to a spot market for compute. And if you look at the history of commodification and futures in general, there's a lot of cautionary tales for what happens when you have really perishable commodities like orange juice and onions. Onions are a fascinating one. It's the only time that Congress has ever banned a futures contract by act of law. And long funny story on that, but you can look up the Onion Quarter if you're
What happened?
Onion
Yeah,
Curious.
why did they say no?
Basically,
Unfeasible things.
So basically, two traders bought up meaningfully the entire deliverable supply of Onion futures. They positioned themselves in a way where they were then able to corner the market, take out big shorts, and collapse the price. And because of some contract nuance and the whole way that they put this trade on, they were able to make a lot more money off of the short than they were from what they lost from being long these contracts. But it's really only possible because of perishability for onions and the fact that they were difficult to standardize and grade. Like onions are, I'm not an onion expert, I'm talking about like I am, but there's not a defined deliverable grade for onions. And this ended up becoming a big problem in this contract. So the through line for all of this is that like when you look at really perishable commodities, and compute is the most perishable commodity that's ever existed. It can't be stored like power. There's no way to meaningfully transport around. You can kind of bring workloads to it, but you can't store or move it anywhere. So it's worse than electricity in that regard. When you look at the history of perishable commodities and commodities that don't have meaningful spot markets, it's never a good outcome. So we're betting that compute similarly needs an actual full financial stack that ends with people getting compute.
Yeah, like the ability to take delivery of compute does seem as though it needs to exist somewhere within the market.
Yep.
So that at the end of the day, I have a future contract, futures coming to expiry. I bought like $10,000 worth of GPU cycles in an AWS US East environment. I can go and run compute on those $10,000 worth of compute cycles.
Yep.
But once that exists, once the actual the ability for like take delivery of compute exists, don't you just start using that for the index?
So that's exactly how futures should generally function is you have a future that then collapses into a spot market for it. So even stuff that's financially settled right now, so like you have E-mini futures, you have futures on the S&P, right? The thing that makes equities work really well for this is you have a completely transparent public bulletin board for every trade that's ever done at every price. There's total transparency to it. And in the case of anything that's like a structural market-weighted index or to something that's like an equal weight index, very easy to calculate, no ambiguity as to the outcome. Something like compute, where transactions aren't always going to be reported, there's a lot of incentive to report or to not report things when you're looking at a financial index. And even if you're, quote, tying it to transaction data and saying like, oh, okay, this is a good mark on it. Again, you have that censorship problem of someone's doing a huge block of compute with someone and someone else is doing a little micro transaction. That's the thing that's actually getting reported. Like what's more indicative of the market in that case.
So you're going more of you actually want to work on the exchange that allows for delivery of compute, not just tied to the index, if I take it correctly?
We 100% see it as a full stack problem. So this market ends with there being a deliverable market for compute. The question of how you get there is a series of steps in the financialization process in general. And like, we're talking about deliverable compute right now, where it's just like, hey, here's your compute. And there's a lot of technical complexity to how this would have to get built out, which is kind of its own big company.
Yeah. Like because you had mentioned it earlier when we were talking about is that like there's not true commoditization of compute, like the geographic location relative to the actual specs of the compute. What is the amount of memory on the compute? So like there's a lot of differentiation. How do you then have to negotiate with each neocloud separately and have a separate compute future per neocloud? And then if I guess is the natural extension then that like I actually don't go to an exchange for that. I just purchase that on the neocloud's portal of purchasing compute versus on a separate exchange if I'm using it just for hedging. Like how do you think about when you actually are creating a financial stack, because it's not necessarily an exchange, but a financial stack for compute futures of where is then the portal that the person that is going to ultimately take delivery of that compute actually going to? Am I going to that NeoClouds portal and just purchasing it? And there's kind of like a Klarna for compute purchases using this future market, or I could just pay for spot right now. Like how does this change the UX of compute purchasing from a consumer perspective?
Yeah, that is like such a fascinating and deep question on this. And a couple of interesting points, but like, I guess it's working backward. So, and with crude trading, you have Cushing as a delivery point. Everything is standardized around a certain grade, gets delivered in Cushing, Oklahoma. And then you have basis markets that basically price what the financial offset should be for if you actually want your crude in Texas or Illinois. So what's that going to look like for compute? There's a couple of things on our mind. So one is you need physical deliverability standards. And this is really, really technically fun and nuanced to work on for something like compute, because with crude, you just have a couple of dimensions, right? You have like sweet versus sour and light versus heavy. Those are kind of the key dimensions. And there's coarse grain grades within that. But refiners can work with a lot of stuff. And with compute, you have this extreme nuance of like some models physically will not be able to run on an older chip because they can't fit in RAM. You have other situations in which they'll perform worse, but you can still totally run it. So compute, unlike commodities in general, like it has this problem of its workload. The value of it is workload specific and by proxy buyer specific on it. So you end up with a lot of different basis markets and a lot of complexity related to how you match this off. And our view is the only practical way of doing this is to solve for it with a combinatorial auction.
And then do you change the interface as well? Like, does it also have like, when you take delivery, is there like a Heroku API of GPU interaction that abstracts away the actual provider or issuer of that compute and goes through like a OneChronos interface that kind of abstracts away the different ways that you may interact with that compute?
That would be completely clutch. It's a really hard technical problem that people are working on right now, but it's very closely related to even things like CUDA, where CUDA's abstracted away a lot of the complexity for using a GPU. So if you've coded to CUDA and something else comes along that performance-wise can handle the load, but doesn't have that same API, how do you deal with that? One potential answer is that you actually have a financial arbitrage layer and people start thinking more in terms of jobs than they're thinking in terms of the hardware. And like, maybe you're really good at solving this problem. Maybe you can take an arbitrary workload and make it run on something it wasn't specified for. So now you can capture this basis. Basically.
It's kind of similar to OneChronos where you express intent. And not just express the actual transaction that represents the intent. And you can be a better matcher of the execution of that compute workload and make sure that the intent is captured at a better price than somebody that has to obviously have the intent but focus on the execution at the same time.
100%. Since like in this market, you go to buy compute, and as a transaction of saying, I want an NVL72 cluster for some period of time. But like whoever sold that cluster to you doesn't know if you're using it for training or inference, or like maybe you asked for this, but there's actually something else that they could give you for cheaper that would service your same workload. Like all that context is kind of lost in the void usually. And the way this is handled right now to some extent is like, it's a very brokerage heavy market, either implicit or explicit. That's just how compute's kind of trading right now. So it would be this like really great irony if AI compute for agents ends up trading via human brokerage model in the end. And like that irony is a little too great for us, which is why we're very focused on how do you get that complexity into the exchange. And that's something that you unlock with combinatorial auctions.
Totally.
So how does a fund that's interested in connecting to your exchange connect to it? And in the context of institutional investors, where does a prime broker fit into that stack?
Yep. So OneChronos' message is very much that we are a partner to the sell side on delivering what clients are looking for in terms of execution quality, in terms of features like expressive bidding. But our relationship is always with the sell side. So the way you get access to OneChronos is you have that conversation with your broker about how they're using how they're using OneChronos, if there's anything for their specific intents and portfolios and trading styles that they should look at. That's how you can come into OneChronos.
Is there any technology infrastructure that needs to sit on the fund side in order to actually book those trades?
Yeah, a big part of what we focused on with the UX for all of this is not breaking traditional workflows.
Mm-hmm.
So we talk about all this cool combinatorial bidding stuff we can do. And that has to operate as an overlay where people that want to send a limit order in or treat us as another exchange, they totally can with no friction for that. It's then the brokers that have access to what's called an expressive bid, which is a little snippet of code that runs as part of the match process to shape the optimization for your orders. And that code is just a tag that sits in a fixed message for folks that are unfortunately familiar with the fixed protocol. That's like the lingua franca for getting orders in and out of exchanges. So it sits within existing execution systems and flows as this kind of an overlay.
Understood. Like one of the things that's really interesting, and I think we talked about this a little bit when we first met. I think that AI has the ability to not only streamline what funds are doing right now, but also open the door for a lot of them to do things that they didn't previously have the ability to do.
Yep.
And so do you think that with the rise of AI, with the newly freed time of a lot of investment professionals and the ability for everyone to now be a coder, how do you see that changing the accessibility and the frequency with which institutional investors use exchanges like OneChronos?
So we're seeing this in our customer base already, where there's a refrain of like, we have more time and more capability to do things. Or maybe I shouldn't say more time. The irony is like a lot of us have less time with AI now because
we're trying to do so much more.
The opportunity cost is so high of like ever unplugging from your agents. But we do see this with our customer base. And our message is still that like coming in through a broker is our forward and future for this. It's kind of just because you can build a SaaS with an agent right now, I don't think that the future of this is funds no longer relying on their PBs. I think the future of it is funds having a lot more bandwidth to do research and do interesting things that allow them to leverage our capabilities and their PB's capabilities even better than they already are.
Yeah. And as someone that's been working in this space for 10 years, how do you think that the more recent evolution in AI has changed the execution space or will change it moving forward?
Yep. So there's a lot of talk in general about how people are using AI for strategies, as in like actual alpha discovery and portfolio management. There's also discussions of like how running a big hedge fund used to and still is to an extent, but like a very headcount intensive business when you factor in all of the non-trading stuff that needs to happen to operate a fund with investor relations and compliance and audit and all of this. And you're definitely seeing people able to operate bigger things with fewer people. So I think that is going to be one transformation in the space. And longer term, it's interesting to think about, right now there's a lot of consolidation in general. Is there a future in which there's actually kind of on some level more democratization of it because people can strike out and do their own thing?
What do you mean by democratization?
It's pretty daunting to try to set up a hedge fund, and the cost of capital is one part of it. But a lot of it is just everything that you have to do to be a fund in general. So there's been a lot of consolidation in the space because it is harder when the table stakes are so large and so expensive to operate something. There's a lot of good economies of scale for being under one platform. So I'm just kind of interested to see and I don't know the answers. It's really just a question of how do these things evolve over time? you're seeing in startups that there's a lot of solo founders that either wouldn't have been founders or would have had a team working with them.
Yeah.
And now they're able to just strike out, right? So like where else in our life does this start applying?
Yeah.
One of the things you said was that funds are human intensive. And I like to think that funds are inference intensive, where whether the inference is coming from a person or the inference is coming from an LLM,
Yep.
there's just a lot of information that needs to be synthesized from top of funnel research process to like an execution process to a back office process to a legal process. That information is inherently the business that an asset manager's in, and inferring, synthesizing, and making a decision around that information is something that a fund has to do a lot of. And right now you need to have a lot of human beings to do that inference. And the hope is, and we see it like in real life, that more of that inference and decision-making can happen by an AI. I'm curious how you think of inference and compute markets and how tightly they're going to be coupled, and how relevant an organization that isn't doing any fine-tuning, model building themselves, is not actually consuming GPUs for the purposes of training. Although I think that actually will start happening and it'll be easier for most organizations to do. But at least right now, most organizations' AI spend is on the token consumption and not on the compute side. Do you think that if I use compute as a proxy for my future token spend, that will be a good enough hedge for organizations that want to lock in pricing of their inference costs when they're primarily relying on ChatGPT, Anthropic, other like SaaS providers that are providing pass-through costs of their inference costs? Or is that going to be too much? Are they too decoupled right now?
So I love that question. And I think there's two layers to it. So one is it's probably the best hedge that you have on some level right now that's available anyway, since everyone working on frontier models has very, very high model serving cost for this. Like training used to be the discussion of like, oh, it's really expensive to train one of these things. Like that ship has sailed. The expensive part is serving one. Being a little reductive, it's still very expensive to train a model, but serving it is the big problem. The interesting question everyone's going to have for token consumption is what happens longer run when it's no longer possible to subsidize what those costs are looking like on the back end. So that's on some level related to the cost of compute, but it's also very related to the cost of capital in general for those companies. And the second question is, how much of a premium can those inference tokens actually demand? And like, what is an inference token 2 years from now going to look like? And this is one of the hardest problems of standardization and like why compute is not oil, because a barrel of oil has the same energy content in 2031 as it does in 2026 for a 5-year forward, versus that token, it's going to be completely irrelevant if you tie it to a model right now. And if you say, okay, well, it's a token on a frontier model later on, what does that mean? Both in terms of how that model consumes tokens, but also like, can that frontier model double your revenue? Or is it actually now just table stakes that everyone has to pay for to deliver something at all, and your margins actually way down? And like that fog of war is what everyone is trying to deal with and hedge right now. And compute is a hedge-ish, but it's not a strong hedge. And like part of the financialization that we're working on is really around what that strong hedge is.
And the differentiation of token value, I think, changed a lot just over the last week with Fable 5 coming out. And the true differentiation between Fable versus Opus versus the best ChatGPT model that I think, for me, changed the dynamic a little bit. I thought there was starting to be more model parity and you're going to see marginal improvements. But then it seemed like there was a step change over the last week in the way in which I think about, oh, maybe there truly is significant opportunity for differentiation in terms of inference value still to be had. I'm curious. I'm assuming you've used Fable 5.
Yep.
What's your experience with it so far?
It's a great model. Yeah, it's a fantastic model. And something you just said here is also very true of it, which is it is a step change up from what existed before with Anthropic. And it is still a mixed bag for different workloads, which any of the model providers are winning. It's like sometimes you actually want to just churn a lot of a cheaper, smaller model quickly.
Mm-hmm.
Sometimes you want frontier intelligence, but even when you look at benchmark scores for stuff, it doesn't necessarily capture the lived experience. And that's not surprising. Like that's the crux of the really hard problem here is that all these models are going to be different. They're all going to have different value characteristics to it.
Mm-hmm.
So when you think about how you define standardization and benchmarking for this, like it's a very hard problem.
Oh yeah. And we see it like internally and in our clients where Claude is, if you go directly through Anthropic, it's expensive. If you use Composer 2.5 and Cursor, it's cheap. If you use Copilot, it's oftentimes cheaper with the different options that you have there. And like, we'll have people that'll be in, I went to a client like this last week and we're in VS Code and we're like, oh, I use Opus a ton when I have a hard problem, but like, I'm just switching over to using either Composer 2.5 and Cursor for like most of my daily driver because it's just faster and cheaper, or I'm using VS Code as my daily driver because I don't need to go to the Claude consumption-based model because I can pay more of a subscription base. And you're not seeing as much of the stickiness to one model provider when you're starting to get a lot of UX to allow people to differentiate like on the fly, and they're getting more in tuned of like, oh, when I should go to one versus the other. I'm thinking about the pricing model of whether it's subscription or it's pay per use. And I don't know. And people are getting smarter around the differentiation of which model to use. And so that's then playing into like the optimization function that people do on a micro level of when they're using AI. It makes it even more challenging as an organization to think about how do you hedge and optimize spend across all these different models.
Yeah. It's funny because if you swapped out a few words there, you wouldn't be able to tell if we were talking about model serving and inference or if we were talking about equities electronic execution. As far as like, oh, this algorithm does really well on this type of order, and this does well in this order, and this broker specializes to this and that. And like, this is the game that everyone is in right now is I have this high level intent or goal, which is to go from portfolio A to portfolio B. And I end up playing this like very complicated and increasingly expensive game of trying to figure out how to do that instead of having one layer that kind of solves for that.
Mm-hmm. And a lot of the tools that people are used to, like Claude Code with skills and plugin and MCP, those are completely agnostic to what model is executing the inference. The Claude Code is just a harness and a system prompt and a way for that harness to interact with these other tools. You can swap out any inference model provider into Claude Code and it'll just work as long as it implements the Anthropic API interface the same way that OpenAI has their interface. And you use something like OpenCode and use any of these different model providers if they work with the OpenAI interface. And I do, to your point, I do think not only like the OneChronos model of like, hey, like we can help optimize for that from best execution. You can do that while still using the harness that you're used to. Like you could still use Claude Code just as you do right now and have either like Open Router or you could do LLM Lite as a proxy in between. And then like a smart middle layer right there that's going to route it based off of what's your intent. And the intent can be kind of clear based off of how you've prompted it. And have to be a very light, simple model. Like is this a hard problem, easy problem, basic problem? And then have that do the routing, which you do also get. Claude Code like has the capability of that. Like you can, within your Claude Code config, you can say like your hard and your easy model. And you can say like, hey, the hard's going to use Opus and the easy's going to use Sonnet. Hard's going to use Sonnet, easy's going to use Haiku. And then the model makes that decision as it's going through the execution. Just, you can get rid of the Anthropic components there. So the agent harness, the ability to start differentiating based off of compute and almost have an exchange like that. These middle layers as routers that are starting to be standards. It's a really cool time to be like figuring out where you are within that token supply chain, the model inference side, the training side. And you guys are right in the mix of all of it.
Yeah. And it's my favorite thing to work on right now, since it's such a societally important problem in my mind too. Like, you get this right, you get compute for basic science. Like, there's so much that we can unlock with ubiquitous compute, but it really starts with, in our mind anyway, it starts with the market. It starts with a market that makes it easy to finance compute projects that bring compute online. And then everything that we're talking about downstream, it's a meta circular problem. The smarter the AI gets and the more compute it has, the better it is at building the tools we want it to use.
Mm-hmm.
And the better it'll be at optimizing its own compute.
100%. Bidding in its own OneChronos compute expressive markets.
Yeah, exactly. Like, to your point around right now, you can use Claude Code to have it delineate the hard problems and the easy problems. I think the next derivative of that is the LLM breaking down a problem into as atomically distinct units as it possibly can be, and then delegating out those pieces to various agents to optimize the compute of even one prompt.
Mm-hmm. And like, would you ever get Anthropic and OpenAI competing based off of price for the right of fulfilling inference on a per request basis? Like, could you have a true on-demand market for inference that has a floating spot price? And I think you totally could. I think you absolutely could. Like, if you get more open source model providers in the mix and you get less vendor lock-in from the agent harnesses like Claude Code, like have the FTC or have like a anti-monopolistic threat saying like, hey, you have to allow with Claude Code any model to work without saying that's against the terms of service. And then you allow for a middle layer to allow bidding of like, hey, I'll run that inference for you right now, sub millisecond, so the user doesn't even know, and they're getting the smart order router, not just on compute for training, but they're getting on every single token they're consuming. And from a consumer perspective, you then get to have somebody else do the hard job of arbitration of cost, and you just get great outcomes. I think that would be awesome.
Yeah. I mean, you have your own agent sitting there bidding on compute.
Mm-hmm.
But if everyone's doing that, doesn't it all kind of level out?
Well, you still have differentiation, right? Like, you still have Fable, where they can do some awesome stuff that no other models right now can. And so if you're saying like, hey, like, this is a really important problem, I'm willing to go to the expensive model and I'm willing to pay for it, you're going to be buying the premium, like, unleaded gas. But if you express intent, same way I guess your exchange was kind of set up to do, of like, hey, I just need this fast, I need it good enough, it doesn't need to be perfect. It acknowledges that intent and then just goes like fast, quick, Kiwi, hosted somewhere like locally. Actually, I don't even care on jurisdiction. And there are benefits of, like, Anthropic does offer some of this. Like, you can use the batch-based API. It's like, hey, I need you to run all of this analytics. I don't need it right now. Get it to me sometime. I think that is it 24 or 48 hours? I think it's 24-hour guarantee. It's sometime over that time period. It's 50% off, something like that, I'm pretty sure. And so there are these also like non-spot, non-on-demand compute that you can have. But I think it's going to be, it'll be really cool if it can get down to something that is constantly bidding at the user perspective and allow competition for tokens at consumption time to happen. And like, that'd be the coolest thing for like free markets and users in an AI world that I could think of. That'd be awesome.
Yeah, it's hard to think that the world doesn't get here on some level.
Mm-hmm.
And you need to kind of look at the history of ad markets, which academics and mechanism design also love studying. It was kind of like our first test bed for some of this stuff. You go from this era of no sophistication to giving people so much sophistication that you're really putting it on them to figure out exactly how much to pay for an ad and like what it is that they're trying to measure, back to a high level statement of, here's my campaign, here's my overall budget, and here's 1 or 2 or 3 metrics I'm trying to optimize for.
Mm-hmm.
And you would think that would be kind of weird going to a single ad provider and saying like, yeah, $1,000, spend it.
Yeah.
You would think that there would be poor incentives with that, but the market's competitive enough. It actually works great because they're not thinking this is $1,000, one and done. They're thinking this is one of hopefully many transactions if this goes well. So market's very good at keeping itself in check on that type of stuff. When you think about like what the ad market for compute is going to look like, I think there's even an extra angle of it, which is your agent is the one that's in there doing the work, but you're kind of eventually getting away from this. Here's how expensive a marginal token of production is, and towards like, hey, this is the task that I want done. I could care less what model you used for it. Like, here is the deliverable, and there's going to be some scoring. Not a completely easy and solvable problem, especially for deliverables that are very subjective, like code and everything else. But again, like this is a subject that people have worked on before, which is how do you grade and how do you peer review results in a way that ensures good behavior on a repeated play basis.
Mm-hmm.
But the onus there is really on the KPI, right? Because with ads, you can quantitatively assess the efficacy of a campaign based on actual numbers like revenue changing.
Yep.
But with a problem, if yes, there's a really distinct rubric, yes, there is a scoring system that's somewhat straightforward. But if there's not, the user needs to figure one out, and they kind of trade not necessarily having to care about the model or how the actual sausage gets made for the responsibility of figuring out what good really looks like, which is what I think a lot of people are struggling with with AI right now.
But what if the differences are really on the edges? Like, yes, you can look at sales and revenue with ads, but there's tons of bots and fake impressions in the ad network space that there's a lot of fraud at the same time. And so, like, let's say you were to go to a smart order router and they do have some optimization function, or you kind of do it on your own, and there's not really that big of a difference between the two. You end up selling more through both of them. And the execution engine is like, hey, like I can just charge a little bit more. They're still getting the job done. How do you ensure, like, how could you sell an offering to an AI customer that, like, hey, we have some element of assurance that you're getting the optimal routing? Interesting problem to solve. Yeah.
Yeah.
I think there's a sliding scale of problems with this. So like on the one end of really easy things in a way, you have mathematical proofs where it's easy to state exactly what it is that you're looking for. And you have a theorem prover that can then check whatever is produced on this. That's like a pretty open and closed thing. So software is like somewhere in that hierarchy of, in a way, you can test the software that gets generated. It's a lot more subjective. There's still an element of human review for this, but we're in general betting on more of software looking like formal methods and proofs in general. And then on the complete opposite side of the spectrum, you have something subjective, like you ask for a new piece of art for your house. And not only is it like beauty is in the art of the beholder, like there is really no objective score for this. So I don't think we're going to one-shot every problem on this. But if you look at like some of the already really economically meaningful ones, like software development and all sorts of data entry and tasks and labeling and whatnot, like, yeah, I think we already have the tools to turn this into a marketplace. It's just a question of how those tools get used.
And with that, let's call it. Kelly, this is an awesome episode.
Great discussion. Thanks for having me on.
Yeah, as a blast. Come back anytime. And so with that, thanks for everyone for tuning in. Again, this is the Hedge Engineer Podcast. We try to push episodes out every week, launching on Tuesdays. You can follow us on YouTube, Instagram, TikTok, a lot of stuff on LinkedIn. Until the next episode, take it easy.
The Hedge Engineer Podcast releases episodes weekly on Tuesday. Our hosts are Michael Watson and John Viverani. The Hedge Engineer Podcast is produced and edited by Aaron Free. Follow us on your social platform of choice and reach out to us at podcast@hedgeengineer.io.